Are you a Canadian losing money on your rental properties? If you're concerned about how this will affect your taxes, you're going to want to watch this video right to the end. Hi, I'm Rav. I own Think Tax Professional Corporation. We specialize in personal and corporate taxes for small owner-manager businesses. And my goal with the channel is really to educate the Canadian population so they can make informed decisions. Now, we all know that Ontario real estate has been on the downward trend since 2022. Prices in many cities have pulled back from their peaks, and higher interest rates have pushed carrying costs up, while squeezing cash flow for many landlords. So if you're feeling the pressure, you're not alone. But there is one small bright side. Rental losses can actually be advantageous for you come tax time. Today, we're breaking down how rental losses are taxed in Canada, how they can reduce your overall income, and what the CRA looks for when you report rental losses year after year. So let's get into it. First, let's start with what is a rental loss. A rental loss is simply your deductible rental expenses are higher than your rental income that you're collecting from tenants. So, for example, let's say you collect $18,000 in rent, and let's say your expenses are $22,000, which could compromise your mortgage interest, your insurance, your property taxes, repairs and maintenance. You now have a $4,000 rental loss. And yes, that loss can reduce your taxable income, but there are rules, CRA limits, and scrutiny that need to be kept in mind. So what are the type of expenses that can create a rental loss? Well, common expenses could be mortgage interest, property taxes, insurance, repairs and maintenance, condo fees, utilities, advertising, accounting fees, management fees. You could also travel to manage the property. These are all legitimate expenses that can push you into a rental loss position. And of course, you report these on the T776, the statement of rental income. This statement is the income and the expenses of your rental property. Now, there is one big expense that can really swing the numbers, and that's CCA, or your depreciation trap. CCA, or the capital cost allowance, is the tax version of depreciation. It lets you deduct a portion of the building's cost from year to year. But here's the catch: CCA cannot create or increase your rental loss. So if you're already in a loss position, you can't take CCA to make the loss even bigger. Now let's get into an illustrative example when you have rental losses and you use CCA. Let's say you have $20,000 in rental income and $25,000 in expenses. With this, you have a $5,000 loss. Because you have this $5,000 loss, you cannot claim CCA to make that loss even bigger. In other words, your loss will remain at $5,000. Now, can you use rental losses against any other type of income? Well, yes, and this is where CCA becomes really powerful. If you have a rental loss, you can apply it against other sources of income, such as employment income, business income, investment income, pension income. This reduces your overall tax burden for the year. So if you're in a higher tax bracket, a rental loss can generate real tax savings. But it's important to know that the CRA wants to know that this is a legitimate real business and not just a tax shelter. Now let's get into whether you can claim rental losses back or forward. Now, most rental losses in Canada are treated as non-capital losses, which means you can use them in other years. You can carry the loss back 3 years to recover taxes that you've already paid. You can carry forward losses up to 20 years to reduce future taxable income. This gives you real flexibility, especially if your income fluctuates from year to year. So instead of a bad rental year hurting you, you can smooth it out over a period of time. Now let's get into the CRA's expectation of profit test. If you report rental losses year after year, the CRA may review your file. They want to know, is this rental property really expected to make a profit? The CRA looks at factors like, are the rents reasonable for the market? Are you actively trying to make the property profitable? Is the loss temporary, or is that your long-term business model? If the CRA decides there is no reasonable expectation of profit, they can deny your losses, add interest, potentially add penalties. Now, this doesn't happen to everyone, but it is a real risk to those people that continue to report losses year after year. So something to consider. Now, let's discuss when repeatable losses are acceptable. Not all repeated losses are suspicious in the CRA's eyes. Losses could be acceptable when you're in a high-cost market, you had major repairs in a particular year, you're paying down a high-interest mortgage that'll eventually drop. The key is the property should be reasonably expected to make a profit over time. And if you can show that, you're usually fine. Now for one final thought. Rental losses can be a legitimate and very valuable tax tool, but only when used properly. Now, if you found this video helpful, please give me a like, subscribe, and drop a comment if you have a question. And if you haven't watched a video on how rental income is taxed in Canada, check that out next. It pairs perfectly with this video. If you need help with your taxes, my contact details are in the description below.